Welcome to episode 54 of the Cash Flow Connections podcast. Our topic for today is, should you be lending money to real estate flippers in today's economy? I keep mentioning this on the program, but I think taking a good look at debt as an investment vehicle makes a lot of sense right now for a lot of reasons. In theory, hard money loans are a great way to invest in debt as they provide the ability to get reliable passive income, but you're still able to protect the investor from equity risk. You're not taking on the risk of price fluctuations as significantly. We're still able to get some of the benefits of real estate, including collateralization as well as cash flow. But there are a lot of ways that this investment can be done incorrectly. And when they're done incorrectly, investors are going to be the ones that suffer the consequences, particularly when this never-ending economic recovery really starts to turn around. So today, we're going to discuss some of the underwriting standards our guest uses in today's economic climate. We're also going to talk about what our guest thinks of the current lending environment, as well as the economy as a whole. I think that people that are involved in the debt sector, particularly private lending, they have a really good sense of that portion of the market. They're basically driving that market because the debt is the portion that's the most important. You know, you hear, when is the economic cycle over? Well, it's when a bank starts to say no. So on the private side, it's the same thing. We're not necessarily related to the institutions, the agencies, et cetera, but I think it's really important to look at debt when you're trying to predict where we are. They have a really good pulse of what's going on. We're going to talk about what asset classes our guest is willing to lend on and what the terms are for some of those loans. Are they 12-month terms? Are they 3-year terms? What the interest rates look like? We're going to talk about all that. And we're going to give you all one question that you can ask your potential hard money loan brokerage that you may be investing with that our guest has literally never heard a potential investor ask. He's been in the business for many years. No investor has ever asked them this question, and it's a really important question. And we're going to talk about why our guest thinks there will be an opportunity in the stock market in the foreseeable future. In the near future, there's going to be an opportunity in the stock market and how he plans on taking advantage of it. Is it with stock picking, ETFs, indexes, etc.? He's going to get into all of that. Now, just a quick reminder, if you have not already subscribed in iTunes and left a review, make sure to do so. It probably takes less than 2 minutes, but it can make a huge impact on the show's ability to get high quality guests. So if you haven't yet, make sure to go to iTunes, subscribe so that you get the episodes automatically downloaded to your phone, and you can listen to them whenever convenient. And then also make sure to leave a review so that people know that you are enjoying this content. I know a lot of you are. In fact, we had a review recently from SF415, whoever you are out there, I really appreciate it. They said, the Cash Flow Connections podcast is extremely valuable. I have learned multiple secrets and insights that have helped me in my career. Episode 45 about real estate development was fantastic. Well, SF45, I really appreciate the feedback. Really glad to hear that the content has been helpful. So for all of you that haven't yet left a review, I would really appreciate it. And I hope you enjoyed the episode. How's it going, everyone? Our guest for today is Brad Laddusaw, who is a CPA who graduated from California State University, Fullerton, with a double major in accounting and finance. He started his career in the audit practice of Ernst Young, where he serviced clients in the real estate, home building, and retail consumer product industries. After leaving Ernst Young, he joined the investor relations team at a prominent Los Angeles-based private lending company, where he quickly moved up the ranks to vice president of finance. In July 2017, Brad started S&L Capital Group, a Southern California-based private lending firm with his business partner, Corey Siegel. Brad has underwritten and directly placed over $165 million in trust deed investments with private investors. He also holds an active Cal BRE broker's license, an active CPA license in the state of California, and is a level 2 CFA candidate. And over the years, Brad and I have had some pretty tremendous conversations, just checking in with each other, seeing where the opportunities are, seeing where we think about the economy. And I really wanted to have him on just to record one of our conversations. So Brad, I really appreciate you coming on. Thanks again.
Yeah, thanks for having me, Hunter.
So we want to talk about a lot of different topics today. I know that you're super interested in the economy, you're super interested in real estate and the private lending sector as well. So before we go into some of the details of those conversations, let's talk about your background, your firm. how you're positioned in the marketplace. What problem did you set out to solve when you started S&L Capital Group?
Yeah, absolutely. So in this industry, the private lending space more specifically, there's a lot of inefficiencies within the underwriting process itself. At the end of the day, we are not really constricted to the red tape on a consumer lending standpoint. So the traditional submission process that you have in, call it conventional lending, you'll have your originator, you'll have your processor, you'll have your underwriter. Then it goes to loan committee. At that point in time, exceptions will get kicked back to you as the potential borrower. So there is if you want to call it a daisy chain throughout the entire process. Even in the private lending space, there are some firms that are structured in that fashion. But at the end of the day, we pride ourselves on short closing timelines. Any private lender you talk to say, I could close within 3 business days. But at the end of the day, that's not always the case. So we just wanted to cut all the fat out of the operation, especially with new technologies that are available, different resources that you have to, shorten that underwriting timeline without jeopardizing quality. That's what we wanted to do. Per se, we don't need an originator, then a processor, then an underwriter, then to take it to loan committee. At that point in time, you have a 15-day turnaround time to get an answer back. We need to get back to our clients within 24 to 48 hours on if the asset and structure is feasible. And then we move on forward and collecting the file. And the goal in every submission that we take in is to be in a position to move to docs. Granted, we get a complete file on the front end within 3 to 4 business days. And that allows us to be in a position to close between 7 to 10 business days. And that's the ultimate goal of our firm, is just to cut the fat out of the operation, be lean, mean, efficient, and not jeopardize quality by shortening our timelines.
Interesting. You already touched on a lot of things I'm interested in, but before we get into some of the details of those, let's talk about, give us a big picture understanding of the bread and butter types of deals that you're looking at. What is your typical lending deal that you're creating paper on?
All right. So 2 answers for you there. A bread and butter deal would be 25% loan to purchase. Someone that's got $1 million in the bank and we got a nice 4-unit rental property. With that being said, I think I've looked at one transaction like that over the past 4 years. So those don't come through very often. But what we like to put together is we want to have some exposure in the SFR fix and flip structured loan. So in a fix and flip structure submission, we'll probably cap out on our loan amount in the $1 million mark, because then that's going to kind of tip us into that higher end fix and flip value add play. We typically like to be sub $1 million when it comes to a rehab loan. Reason being, once you exceed that price point, you're not going to be putting $40,000, $50,000, $60,000 worth of work into the property. You're going to be putting in 2, 3, 4, maybe 500,000. That rehab's not going to take 3 months. It may take 9 months to a year, and then your end buyer is very limited. So when it comes to a rehab structure loan, our bread and butter will be sub $1 million. We also have exposure to commercial as well that we have an increasing appetite for, more specifically 5 units and above on apartment buildings, industrial warehouse, smaller office space, and retail storefront. We have capacity for bread and butter type structure to go right up to about $4 million on any given loan amount. Our leverage point on that bread and butter that we'd like to be at is that 50 to 60% loan to value range.
Okay. And are these typically located in California, the assets located in California themselves?
Yeah. So all the assets that we look at are located in the state of California. We do originate our loans under the California Department of Real Estate. So we're actually only licensed to lend right here in our backyard in California.
Okay. Got it. And in that introduction, you mentioned something about technology, which really piqued my interest. So what kind of technological solutions are you leveraging to really eliminate that extended time period that a lot of your other people in the marketplace are struggling with?
So technology is not cheap, and there are a few firms out there that provide quite a bit of data for you on one spot. One of the companies that we use, especially transitioning more into commercial, is CoStar. We onboarded with CoStar in January of this year, and they have been acquiring companies left and right over the past few years. Some of them like apartments.com, a few others where they could they could compile all this market data effectively in, I wouldn't say real time, but within a short time period after closings occur, to where when you're underwriting particular transactions, you could really jump into the detail on particular submarkets, call it Orange County, more specifically the Irvine area, and you could really filter down your searches and your data that you're looking at to that commercial asset you're looking at. That is one avenue where that firm is really implementing and collecting all this data and using their platform to distribute this information in a very quick and efficient timeline. They also provide different market update reports, which is important for us to be able to review and I guess get our hands on in a short time period. Mm-hmm. Other avenues of technology, you have some other firms out there that we go direct to our investors. So we're not structured as a fund. So on that, I guess, mindset, we're not putting notes on a platform online, but you have other firms that have popped up that they're fintech type companies where mm-hmm. the investors could just log right onto their platform, their website, review a transaction and contribute to a portion of a note. They'll take down their loans as a company and then sell them off in portions to their investors. So we need to be able to underwrite in a quick amount of time in order to place these with our investors quickly. Other technology, which other firms should use on underwriting, or just having access to pulling background and credit very quickly. You need to be pre-qualified to be able to pull individuals' credit. There's, from talking to a few different firms, we use Settlement One. There's a few others out there, but it's interview process and office tour that they needed to do. And those are just very simple technological advances, I guess you could say, and everything is based online now. The development of, let's call it the cloud, allows you to secure all your sensitive information and call it an offsite location. Little things like that has really changed the landscape of the industry and allows you to be a little bit more valuable.
Yeah, I completely agree. I actually have spent some time looking at CoStar. It's pretty incredible and remarkable. And we do use that in conjunction with our sponsors because the information is really readily available. And it's one of those things where you can have great quality, you can have it readily available, and you can have it be inexpensive, but you can't have all three. So you got to choose two, right? That's the whole thing with that. So the CoStar is definitely not one of those cheap options. So just from a big picture, let's go back to the business thesis. So you're investing in fix and flip properties, commercial and residential. I know that you have a significant amount of experience just looking at the real estate sector as a whole. You totally know what's available in the marketplace out there right now. Why do you think that right now is a good time to be focusing on debt, particularly lending on fix and flip type of properties?
I really like leaning towards the debt side, especially at the stage in the market where we're currently at, because as a lender, you have the ability to earn I call it a healthy return by reducing your risk. So you're not lending at 100% loan to value of the property. As a lender, at times you're actually able to dictate what type of asset class you want to target and the leverage point you want to hit. So say we're focusing in loan amounts anywhere from 60 to 70% loan to value, we have that 40 to 30% worth of cushion or protective equity. So God forbid we have a pullback in the market, you have a little bit softer landing on your investment, and you also have multiple exit strategies. If you're taking an equity play and acquiring this property, you're fully vested at that as is value. If that market takes a 10, 15, 20% hit, you're going to feel that on your principal amount invested. On the debt side, you're going to be okay, especially if your underwriting is done to par. You'll be okay with a 20% pullback. Your note may go into default, but God forbid you take that property back. Now you have an income producing asset that will allow you to weather the storm. So depending on who you talk to, Hunter, there's some individuals that say the housing market is due for a huge correction and it's going to pull back. These same individuals have been probably calling a pullback for the last 4 years. So they've not only missed out on a run, but they feel that the market's at the peak. So if you're at the peak, which I don't think we are, for the record, but if you think you're at the peak, it wouldn't make sense to start a long-term investment buying at the top. I would much rather lend at call it a discount to the market if you had to take it back, reduce your exposure, still yield, let's call it anywhere from 7 to 10% on an annualized basis. And I think I don't want to use the word wise. I think it's a more calculated approach on getting a return that is mitigated. One counter I always get, Hunter, from new investors inexperienced, they say, well, interest income is taxed at the ordinary level. So after taxes, my return is cut in half. I say, you know what? You're 100% correct on that, even though you should verify that with your CPA. I'm a licensed CPA, but I was in audit, not in tax.
And you're not the person's CPA. They need their own CPA to verify that.
Yeah, but my point I'm getting at, and that I tell them every single time, is let's call your net return then as 4.5%. Market cap rates right now on 5 units and above for multifamily. I mean, I'm seeing cap rates as low as 3, which is insane. 4, 5.5% in the LA Orange County market. So at that point in time, if you're buying in at that cap rate and your return is in that 3.5%, 4, 5%, and now you're buying at the top and we'll take an equity hit if that market pulls back, why not take your net return on the lending side, reduce your exposure, call it after tax if you're still yielding 4, 4.5%, but then you're going to have more exit strategies if you have to weather any storms. That's kind of why I really like the debt side at this stage of the market.
Yeah, I definitely think it's interesting. And I have been personally investing in debt quite some time, trying to stay away from that equity risk of depreciating assets. I'm very interested to hear about your thoughts on the marketplace. We'll talk about that in a moment, but just to kind of reiterate that, one of the benefits of debt, yes, you are getting that reliable cash flow without the equity risk. You're also able to do it passively in the sense that there is at least one step of cushion in between you and the asset. And in the event that someone defaults and you take the asset back, it's usually financially beneficial for you to do so, particularly in non-judicial states like California, which is, I'm assuming, one of the reasons that you set your firm up here and focused on debt in this particular market. There's other states where that business model is not nearly as viable. There's certain ways around it, but you can mitigate that risk. But at the end of the day, what are you typically seeing when it comes to foreclosure for a property like this, which is non-owner occupied?
I mean, right now, the market's been so strong the past few years. I mean, I would be concerned if a lending firm has had a high volume of foreclosures. But on a natural foreclosure timeline, say you had to go through the process in the state of California, you could call it, in a best case scenario, 4 to 5 months. But if you have a distressed borrower, they're going to be trying to do whatever they can to delay that sale, get you paid off, or just not lose the property. So it could very easily get stretched out 6, 7, 8. I've even seen 9 months, especially if they move in a tenant, have some falsified leases. Now you're dealing with evictions, or they file BK right at the finish line. And now you have to try and get that removed. So the timeline could be extended, but overall foreclosures in the market, there hasn't been too many whatsoever. And even talking to other trustees that I know that specialize in the foreclosure process, they actually, it was just the other week, I was at CMA for a conference and talking to one of our trustees, and he's like, the first half of the year has been extremely slow. He's like, we just haven't seen any foreclosures coming through. And you see that just with the natural appreciation in some of the markets we're focusing in. If someone gets distressed, there's still room in the asset on the equity standpoint for them to refinance that loan. They're not going to be doing it conventionally. They'll probably be going to another private lender that's okay taking on the risk based on the location.
Interesting. And I definitely see that. It's one of those things where people say, what's your track record look like? It's like, well, it looks really great because when the market is appreciating, people aren't going to be allowing properties to be foreclosed. They will make it work. If something goes wrong, if they go over budget, they're going to call every uncle they've ever had and many of them that they didn't have to figure out a way to supply the capital to finish the product so they can get access to that equity that they're creating. So you just don't see a lot of foreclosure, which is actually, I appreciate you being transparent about that. It's definitely valid. But then also, if there were to be a foreclosure right now, I guess that 6 to 9 month period is probably important. The one time where that really is critical, in my opinion, is if you're investing in seconds and the person defaults on the first and you want to protect your position, so you have to keep the first current. That extended, let's say, extra 3 months can make a significant difference depending on the size of the first. So when you're investing in properties in California, where the first can be very large, you can see like some of the numbers you were talking about earlier, let's say $500,000, $700,000 first, that can be a significant monthly payment, especially when you compare it to your potential second size of, let's say, I've seen seconds written from $50,000 to $100,000 using a similar model, though not directly related to what you were talking about earlier. So that's interesting. Regarding the appreciation through market conditions, you mentioned that you don't think and don't see us currently being at a peak. What are some of the things that make you feel like that? What's some of the data that you're looking at that suggests that?
So I attend a lot of forecasting dinners, whether they're equity-based fund managers or even real estate-based. I can't take credit for all the analysis that I look at. I mean, I'm a firm believer, if you're in the private lending space, you should listen to Bruce Norris speak at least once or twice a year, just to kind of get his pulse on the market. Can he be wrong? Potentially, any person can be, but the amount of data that he collects and compiles over multiple, let's call it decades. I mean, past performance does not dictate future. Past corrections don't always, those triggers may not be the same ones we have going forward, but where we're at on individuals acquiring properties, let's say here in Southern California, a lot of banks, lending is starting to ease up a little bit conventionally, but people are still having to, on their first home purchase, are having to come in with 20% down. They have those creative programs out there where you could come in with, let's call it 5%. But the income that they're generating from their normal job won't allow them to only come in with 5% down, especially with the price points that we're in. So there's properties are being acquired with individuals needing to come in with a lot of capital. There's a lot of equity established off the purchase price. New home starts and builds. We're not even to the capacity that we could take on. And this is coming from listening to Bruce speak as well. There is still room on the new construction starts. Another key indicator that he has pointed out over time is you really need to be concerned when lenders are writing loans in areas and at leverage points they normally do not, or their previous underwriting guidelines wouldn't allow them to do that. Lending really hasn't eased up even close to that standpoint. So there's just a few factors there in itself where I feel we have room to run. Also, consumer confidence. The job market is heating up. There's other factors that are coming into play to where we're not at a tipping point. The markets, whether you're in real estate, equities, fixed income, investing in portfolios, just because you hit the past peak where that last correction was at and surpassed it doesn't mean it's going to stop right there. Markets naturally over time will appreciate. You'll have corrections. You'll go up to that point where that last, call it fallout, however you want to describe it, occurred. And you're going to go in excess of that and you'll go up. But it's important just to keep an eye on these speakers that specialize in the field. What I look at as well on fix and flip. That margins aren't quite there or where they used to be a few years ago. Those are tightening. So you have a lot of people, like I said, coming in with more equity. An indicator that we look at on assessing default risk. Chances are if someone's coming in with more equity to close, a lot less likely for them to, let's call it, let that property go into foreclosure and have them lose it. People are, I don't know if you play poker, they're more pot committed right now. So they're not willing to, I would say, let it go. But there's pockets. There's certain areas that are kind of, call it worrisome for me. We may go into that a little later, but they've had certain pockets that have had crazy price appreciation over the past couple of years. That's just not sustainable. San Francisco, for example, scares the crap out of me, but I really like Sacramento. So there's certain pockets that are good, and there's others that have had that run up that cause, I don't know if fear is the right term, but warrant a harder look before writing loans. Cap rates in multifamily, I think we've seen quite a bit of run up in value just on the compression of cap rate. So there's certain assets you need to be careful in looking at, but when it comes to being at the top of the market, I don't think we're there.
Interesting. Yeah, that's fascinating. And I agree completely, especially about Bruce Norris, in the sense of he is so overwhelmingly knowledgeable and so focused on one particular thing. And his calls historically have been pretty unparalleled in the sense that you have to be able to, if you're going to be an effective market timer, which I don't know if he would consider himself that, but I would consider him that, you have to be able to signal both the buy and the sell. And I'm not sure how many books he's written, but the two that are focused on marketing timing that I'm familiar with is The California Comeback, which was written, I think, in 1990s, right before the insane run-up. And then the other book, I think is it The Coming Crash? Basically timing the two pieces that are just so critical. And if you just simply did those two things, you made a lot of money. In fact, I personally know people who were able to effectively make millions just by listening to that and just by holding out for a couple more years prior to that correction. So, he's a brilliant source, and I do hope to have him on the podcast soon. We've exchanged emails in the past.
Yeah, and I just want to add to that. It's important to not only listen to one speaker. Naturally, people can get biased over time. Not saying he is, but it's important, I feel, to take different views on the economy because everyone has their idea on where we're headed. But it's important just to take the numbers for what they are. And that's what Bruce does such a great job at. But it's also, I feel, important to learn from other people's mistakes over the years. You look at some firms in this space that have been around since the 80s. They've weathered multiple storms. They've probably seen some indicators over time that at that point in time, they didn't realize that it was going to be a trigger, but it was. Are they seeing something repeat a couple of decades later? So it's important to have sit downs with others as well. Sit down with brokers. What are you seeing in the marketplace? Are you seeing buyers just backing off? Is there other triggers that may be coming up that they don't even realize may be a trigger, but you sitting down with multiple different individuals in the space, listening to speakers like Bruce speak and other forecasters, you could kind of piece these different, mindsets together and come up with your own analysis to make sure that you're positioned and actually comfortable with the space you're pushing in.
Let's talk about the private lending market, which is obviously an important component of this. Some people would argue that that's the most important component of all market cycles, maybe not private lending, but the debt side, being that debt is the most significant portion of most purchase prices. So what are you seeing right now in that space? Are you seeing people changing underwriting standards to make deals pencil? You mentioned, increasing the amount of equity, but are you seeing new structures that are popping up to make deals pencil? Are you seeing a more significant amount of seconds that are being necessitated to make deals pencil? What are you seeing in that respect?
So there has been a flood of private capital, let's call it, over the past 3 years coming into the private lending space. With increased capital, you have increased competition, firms looking to differentiate themselves from the other. With that, you've seen new programs pop up that you talked to me 3 years about it. I think it's a reckless loan. Some of the loans, and I hope I don't insult any listeners that may be writing some of these, there's some firms that do it right. They have the resources to take on that additional risk. But I've seen programs pop up, Hunter, over the past few months where they're lending 90% of the purchase price and 100% of the rehab. Granted, that rehab is going to be held in a controlled account. Borrowers coming in, let's call it with 10% down. But depending on the price point, your loan amount, after you factor in financing the rehab, is well in excess of 100% loan to purchase. So if you're writing a loan such as that, you need to have the backing and have the understanding that, hey, if I foreclose on this property, yes, I'm holding the rehab funds at the net pay down of my note, but I'm still in here at 90% loan to purchase price. So I need to have the team behind me to, let's say, finish that rehab, make sure that is being done to code to where I could get that value. I'm seeing some of those structures, Hunter, believe it or not, the rates are in the nines, which is, there's in every investment, there's a tipping point to where your return is not worth the risk. So I feel some of these companies that have popped up, they raised a ton of capital, whether it's institutional or they've created a fund, and now they have to put it to work. So that's where investors, looking at who you're working with, if they're in a fund structure, I would really want to look at what types of loans they're writing, because some of these companies are actually forced to write loans and probably take on more risk than they should because they need to get the capital working. So that is something that I've seen come up. Those types of structures over the past 6 to 12 months, they've really been coming up. And a lot of these are larger funds or fintech kind of platforms or mortgage pools that are writing those types of loans. And I just really feel is they have all this capital. They need to get it working. Now they may be taking on a little bit too much risk. Let's call it their risk tolerances in their portfolio has actually drifted from their initial mindset. Let's call it 2 years ago when they started the fund. When it comes to seconds, I've seen not quite so many, at least for us. I haven't been writing too many seconds just because there hasn't been enough room in the deals. But these other structures have kind of filled in with that, and I think taken the place of seconds. I have reviewed a few, let's call it bailout submissions coming through where the property's mid-rehab and they went over budget on their rehab. Now they need a cash out refi to give them more funds, finish the rehab. A lot of times some of these properties, Hunter, have seconds and thirds recorded, but these aren't coming through private lending firms. These are going directly to self-directed IRAs, directly to the individual. So some investors are being approached and being sold, let's call it a pipe dream on you're going to get a 10%, 11% preferred return throughout, and then you're going to get an equity play. But little do they know there's not going to be much equity left. So that's where I'm seeing some more seconds and thirds being written, but not through lending firms, directly from individuals themselves, which I think is it's unfortunate to see and scary.
Yeah, that's a good point. It's just one of those things where it's really challenging to invest capital right now, to allocate capital. If you do not have a significant network, significant relationships, if they're not already built up, you're looking around and you're saying, okay, stock market, really challenging to make that make sense. Multifamily, really challenging to make sense. Where do I need to go? And so debt becomes really competitive. And then you get these due diligence items and the underwriting standards really shifted. Actually, that brings me to a new topic, which is an important topic. When you're really trying to do due diligence, let's start with a borrower, like your firm conducting due diligence on a borrower, and then what investors need to be focused on when they're conducting due diligence on going through some sort of brokerage like the firm that you operate. Let's start with the borrower side. What are some of the key items you want to look at when looking at a borrower due diligence?
So on a borrower standpoint, let's call it a fix and flip structure loan or rehab loan. I think track record's pretty important to look at in any particular borrower. So if they present themselves as, an extremely experienced borrower, the first thing we ask is, all right, how many flips have you done in the past 12 months? You'll be surprised, Hunter. You get some replies that go like this. Well, Brad, I've done anywhere from 6 to 10 deals over the past 12 months. That's the first red flag. If you're an experienced borrower and you're doing flips, you know exactly how many deals you've done in the past 12 months. It's not a range. Right. It's 7. Right. It's 8. It's 10. It's okay. Great, Mr. Borrower. I think we're going to have a program for you. Would you mind shooting over those addresses? If it takes, 5 days to get addresses on a track record, I'd be a little bit worrisome on that. So that's something we like to look at. We'll pull the grant deeds to make sure that they were actually on title. More times than not, the borrower that gives you the range is actually not on title. They may have been a silent partner. They were the GC. They were the project manager. They weren't carrying any liability. That doesn't carry any weight for me on a track record. So that's one thing we like to look at when it comes to the track record. Another thing on the individual, pulling background and credit is very important. You could find out a lot about somebody looking at that. Over the years, some of our best borrowers didn't have the best credit, but they were exposed to real estate prior to the downturn. They weathered the storm and went through it. Naturally, if you had exposure to real estate prior to the last downturn, your credit got hit. But there's an explanation for it. Now, if you're currently going through a BK, or you have in the past couple of years, that draws some concern. Child support liens, seeing those pop up, that's always a concern. Reason being, if you're not going to pay for your kids, what makes you think you're going to pay for my loan if something goes sideways? I mean, we're mainly focused on the asset, Hunter, and our equity exposure. So if we're pushing the parameters, we're going to jump into the borrower a little bit more. I may want to look at 3 months of bank statements just to kind of see if the liquidity is there. But even with that being said, it's very easy to shift money in and out of bank statements. So we like to see that rolling average that could weather the life of the rehab and payments throughout the course of our notes. So those are the main things we look at on the borrower standpoint.
Okay, perfect. And then let's talk a little bit about, investors conducting due diligence on brokerage firms. So they don't want to actually create the loan themselves. They want to have a brokerage do that. And we'll talk about some of the reasons why they should do that in a moment. But what are some of the questions they should ask? What are some of the steps that they should take when verifying who they're potentially working with?
I mean, one of the first questions I'd ask, really, how are you able to originate loans? Are you under a CFL license, or are you doing loans under a broker's license with the state of California? There's different reporting requirements based on which license you hold. Chances are, if you're doing loans under a broker's license, you may not be structured as a fund, so you'll be originating, underwriting, and selling whole notes to your investors. I think it's important to ask what license they are operating under. Us, for example, we're under a California broker's license, so we have certain requirements that we need to adhere to. A question I would ask, who are you required to report to? What does that look like? And how often do you need to report? Out of all the years, Hunter, that I've been in the industry, I have never been asked that question from any of my investors. Who am I required to report to and why? And what does it look like? I'm required to file quarterly reports to the Department of Real Estate, annual reports. If you're handling trust funds, that is another issue that comes up that I'm sure we'll get into. So that's the next question I would ask if I was an investor. Are you servicing my loans, or is another party servicing my loans? If that firm is in fact servicing the loans, they actually have to get their trust account audited by an independent CPA every single year. That is just the law, and it's there for a reason. Because if you're servicing loans, handling other people's monies that are not entitled to you as the broker, there should be oversight there, and it is there. A question that you per se don't need to ask, but I mean, if I was dealing with investments in excess of $500,000, I would probably ask if there's been any complaints filed against your company or the broker of record. Sometimes the complaints aren't necessarily valid, but they may have triggered an audit, and that's all publicly available on the Department of Real Estate's website. You could actually go and verify your broker, see if there's been any violations slapped against their broker's license, and it's all right there a few clicks away. It's also important to ask, I think, what types of loans they're writing. If you are going to be investing into a fund, I think it's more important to ask the types of structures they're doing, because you don't have the final say on if that loan is being written or not. I think it'd be important to see if that portfolio's risk is actually drifting, or they're taking on too much risk, where we just touched on a few minutes ago. If they're doing whole notes, the way our firm is structured, if you're the lender, at the end of the day, you get to say yes or no on the investment. So there's just a few little trigger questions that I would ask, but the most important one I would ask, doesn't matter if you're working with a private lender or a money manager or fund manager, I would just ask, who are you required to report to? Why? How does it look, and how often? I think that's a very important question that could avoid a lot of undue stress when things get a little bumpy.
Man, that is so much great content right there. So I hope that the listeners really take that seriously, because there's so many simple steps you can do. None of those questions are going to cost you much time, and they're certainly not going to cost you much money. Like you said, you can simply Google this and look on the website. Can you repeat it one more time? It's the California Department of Real Estate, correct?
Yeah, California Department of Real Estate.
Yeah. Right. And so that's awesome. And the reason it's important, of course, is that when things go sideways, let's say they're not in compliance, let's say that they have some kind of trouble with being not in compliance and their firm has to deal with some kind of legal problems, that enters in a completely new set of risks that's not related to the loan to value of the particular property, the track record of the borrower. So what I mean by that is you don't want to incur risks like that without understanding that those situations are handled and how they're going to be handled. I mean, the real question is, if something goes wrong, what is going to happen with the loan? It should be the case that the loan continues to be serviced as is, because their problems with compliance shouldn't be related to the performance of your investment. But even though, you still need to look into that, ask as many questions as possible, and then trust but verify. And there's a lot of different ways that you can do that, which Brad outlined. So, with that in mind, you actually mentioned the trust funds, and I want to clarify here. Could you briefly explain what that terminology means in this instance and what the special treatment of those types of funds are for the purposes of the conversation?
Yeah, so trust funds, in I guess the simplest definition I could possibly think of would be funds that aren't funds of the broker. They're somebody else's money that you are, let's call it, overseeing. So the most common type of trust fund that you will see per our discussion will be rehab funds. A lot of these loans, let's say that they're doing high leverage point loan, they have $40,000 to $50,000 worth of work that is going into the property to renovate it. A lot of times for the lender to take on that risk and write that high leverage point loan, they will actually hold back those rehab funds and release them based on a percentage of completion. Now, those funds can't just be held in some personal piggy bank. They can't be held in the broker's operating account. It actually needs to be held in a separate bank account identified as a trust account, and it can't bear any interest. It has to be a zero interest bearing bank account, because if it was generating interest, the broker would be making money, his investor's capital, and you just can't do that. Mm-hmm. So another example of trust funds would be if the broker is actually servicing the note. They are receiving payment for that loan on behalf of the investor that wrote the loan. They're holding it, let's call it 3 to 6 business days, sometimes 7, depending on the servicer. Now they have funds seasoning in their account that aren't theirs. Once they're ready to release, then they release the payment to their investor. So in that period of time, the broker, it has money in their possession that does not belong to them. So those are called trust funds in the simplest fashion. And that's not necessarily funds coming from somebody's trust. It is funds that the broker is holding. They have to have a separate trust account. They call it trust funds just to keep it, I guess, standard across the board. And then in handling trust funds, there's different requirements you need to adhere to. And I think that was the next part of the question, right?
Yes, that's correct.
So if you're handling trust funds, there's additional reporting requirements you need to do. And this is assuming you're licensed under the Department of Real Estate and you're originating and servicing loans under the broker's license. You're actually required to submit a quarterly report if trust funds were handled, and that report needs to be submitted by an independent CPA. That's each quarter. At the end of the year, you actually have to have your trust accounts audited by an independent CPA. Handling trust funds, you're required to do monthly reconciliations. You can't have any, call it being overfunded or underfunded. The broker can't commingle funds. I think the threshold is $200 of broker's funds cannot be in that trust account at any given point in time. There's just a lot of additional, let's call it, I'm a past auditor. There's a lot of additional headaches that you need to take on as a company to service loans in-house, have them audited, and then reporting timely to the Bureau of Real Estate or Department of Real Estate. Now they just switched it over July 1st, so they're making it easy on us. So there's a lot that goes into a lot more than I think investors realize, and at times I've seen, I think it's a lot more than brokers have even realized until they jumped into it.
Right.
The Department of Real Estate does a great job on posting on all their audits that they have, because they'll randomly audit brokers that report, or if complaints are filed on any particular broker, they'll naturally follow up and do an audit. They submit just a little 2 or 3 page kind of summary on the 10 most common pitfalls of the BRE audit, so Department of Real Estate now. A majority of those pitfalls, Hunter, are trust accounting related. So depending on if there's negligence or if there's just not proper oversight, or the operating systems or the servicing systems aren't there, or the bank recs and the trust account recs aren't done properly, their license could get suspended. If there's complete negligence and there's no resolution, they could pull the broker's license. So there's a lot of risk that could, as you alluded to, you as an investor, if your broker is not reporting properly or doesn't follow the proper compliance, doesn't have their trust account audited, right now they may not be on the Department of Real Estate's radar, but if a complaint's filed, their license gets suspended. Now we're opening up a whole new can of worms, because that borrower is still going to make payment to that broker that's servicing the loans. If their license is suspended or they have to put a freeze on their operations, now that payment is probably not being released to the investor. That investor is probably going to think, what's going on? Do I need to initiate the foreclosure process? I have not seen it go that route. But when we're talking about when times are good, times are good. Yep. Someone very close to me one time said that you find out someone's true colors when things go sideways or south. And it's going to be, it will come up, it will happen. But these are just little simple questions that you as an investor could ask just to make sure, if things do go sideways, is the servicer of my loan still going to be there? Because that's, as an investor, that's what I want. This is a passive investment, as you said earlier. I don't want to be collecting payments myself and releasing them, following up on insurance. I want the broker that is servicing the loan or the firm that is servicing the loan to handle that. I want my monthly interest check. If something goes sideways and that's no longer there, now I'm in call it a heap of different types of trouble.
Yeah, totally. It's a completely different investment profile, one that you going in did not anticipate. So it can cause some major challenges. Now, I definitely want to talk about kind of your big picture thesis on the investment world as a whole, because I know, again, that you've kind of considered a lot of different avenues. And I also know that you're very cognizant of the economic cycle, where we are in the economy, et cetera. Where do you see an opportunity coming in the event that there is a significant correction? You also mentioned, you don't think we're currently at a peak on a global or a national basis, but in the event that there is a correction, what do you kind of have your eye on in commercial real estate, residential real estate, or otherwise?
So in the commercial, keep it to real estate first. Actually, on our overall portfolio, Hunter, we've actually been reducing our leverage points. I was actually reviewing the numbers a couple days ago. Out of all the loans we funded over the past year, only about 35% of our loans have been fixed and flip structured loans. 55% of our total portfolio was in the SFR space, and the balance was commercial. So we've actually been transitioning to extending the terms a little bit in excess of 1 year. Of course, reducing the rate we're charging our borrower. Our investors receive a lower yield, but they have a lot more protective equity established on the front end. I think the opportunity in the real estate side is going to probably be more so on multifamily. I want to say, just because these cap rates have been so suppressed, I think you're going to see when things do correct in certain markets, those values may pull back more than what we're seeing in SFRs. Is my gut, I guess, if you want to call it that. So I think there would be an opportunity there. But more so, I feel there's going to be a stronger play in equities. Stocks is what I think, but not stock picking. It would just be the market as a whole. I think the current market is highly leveraged. There's actually reports and articles, Business Insider, other reports out there where it shows how much of the stock market is actually traded on margin or utilizing debt. And a pullback, if people are forced to cover their margin calls and they have to sell their stock to get that cash, that's going to increase the selling and really push it down equities far faster than normal. So I think there is going to be an opportunity there. Is it right now? No, but it's something worth watching. And I think that's a way to really set yourself up for some longer term gains that you don't have capital gains on. It's going to be pure appreciation with the stocks. And you have to be willing to buy it down. And it's not a stock picking strategy. It would be the market as a whole. Warren Buffett calls it betting on America. So you could pick the S&P index, for example. You could invest in the index as a whole through ETFs that are passively managed to mirror the S&P. You're not looking to get home runs. Just give me my 8% a year. And it's more so about a long-term play, not looking for a short-term gain.
Interesting. Yeah, I think we've had, it's probably our 53rd interview. I think it's actually the first one where the guest has mentioned stocks as a viable investment opportunity. And I can't say that I can't say that I disagree. The reason I say that is that if you look historically, real estate moves like a barge very slowly. Also, real estate typically does not lose value even during recessions. I mean, it's really uncommon. 2008 was a complete aberration. However, stocks, because of the volatility, because of the liquidity, they do present an opportunity. So if you bought stocks at the bottom of 2008, held for 2 years, and then sold those and then bought real estate, you would be just about as good as you could possibly play that situation. And I don't think that would be different in the future, in the sense that if there's a significant correction, the play would be to sell real estate, buy stocks, wait for the income to start turning around. Real estate will start turning around if there is a correction, but it will turn around at a much more slower rate. So again, I like to invest in things that I have an upper hand in. I don't have an upper hand in equities, but that is a strategy that I at least should be taken seriously if someone has interest in making those moves.
Yeah, and on that, Hunter, you got to be, with equities, you got to be careful to try and time the market. It really needs to be, I feel, others would probably disagree, that money managers that actively trade portfolios, but you got to really take a long-term approach, because you're not going to buy it and time it at the bottom, but you could get a good sense on when it's selling off.
Yes.
And you're going to probably want to buy in increments. And then it's also, to your point on selling real estate. I mean, it depends on how much equity you have in those properties. If you have these properties darn near free and clear and they're generating positive cash flow, I would also take another argument or stance where you could take an allocation of that cash flow. Granted, you're not relying on it 100% to live, and you could actually contribute to the market as a whole monthly to where if it's coming down, you're lowering your basis, you're buying the ups and downs over time and just kind of building that nest egg versus trying to time it at the bottom. Oh, shoot, I didn't time it right. Now I'm taking another 15, 20% hit. Oh, there's the bottom. Now I got to wait for it to come up. If you're able to consistently contribute over time, that could really help lower your basis if you are going in when the market's pulling back. And if you have that equity established in your properties, I mean, that could create opportunity for investment in the future when there are opportunities to borrow at extremely cheap rates, free up room for you to acquire elsewhere. I don't think I would sell all the properties. It just depends on which ones you're in and how much equity you have, and just not being emotional with the decision. And that's why I think there are a lot of opportunities in equities, and there will be in the future. Because the last downturn we had individuals, I mean, like you said, real estate, 401ks, across the board, 40, 50, sometimes 60% pullback in the values of those accounts. The individuals that sold their 401ks and withdrew or just pulled from the market, now they realize those losses. The individuals that continue to contribute over that time, they were scary as all heck, but they were actually lowering their basis and are probably in a lot stronger spot now. Actually, I know they are, than the individuals that pulled out.
Yeah, absolutely. And of course, there's a million moving parts to that. You could also look at refinancing. And hopefully, if you're paying attention to this program, and guys like Bruce Norris, you may have sold at a different time in the cycle, not during the collapse of stock market. But so we'll get into that.
Mm-hmm.
Don't listen to this investing advice, but it's just something that I wanted to mention.
Yes. Full disclosure, not advice, just a conversation.
Yeah, exactly. Just a discussion. So anyway, I do want to be respectful of your time. I know that we have to run, and we obviously covered a ton of ground. The information about the due diligence on the brokerage firms is really, really critical, and definitely something that I have not talked about before on the program. So, before we run, why don't you give an opportunity to mention, the name of your firm, how people can learn more about you and what you guys do over there?
Yep. So again, name of our firm is SNL Capital Group. My business partner, Corey Siegel, and I are very creative. So we decided just to take the two letters of our last name, Siegel and Laddusaw, and went with SNL Capital Group. More concerned about the numbers. Everything about us is very public. You could Google our name, Google our company name. We're on LinkedIn. We're on Facebook. We're actively involved with the California Mortgage Association as well as Cal State Fullerton. We are going to be doing more public speaking engagements over the course of the next 12 months. But the best way to find us, Hunter, I would just say go to the most powerful tool out there. Google our first and last name or SNL Capital Group. And all our contact information is readily available.
Awesome. Well, Brad, I can't thank you enough. Really appreciate it.
Thank you for the time, Hunter.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.